Welcome to Celebrity Investing, your go-to source for insights, tips and updates on navigating the exciting landscape of personal and global finance. Please like, share and subscribe for more exclusive content. This is part 2 of the ultimate guide to distressed debt investing. Strategies for distressed debt investing. Investing in distressed debt requires a mix of tactics to manage the risks and increase the chances of high returns. Here are some key strategies investors use to navigate this complex field. Active management. Active management involves hands-on tactics to maximize returns from distressed debt investments. It's about diving deep into the company's situation and taking steps to influence the outcome. Tactics in active management. Detailed research. Conduct thorough due diligence to understand the company's financial health, market position, and recovery prospects. Negotiation. Actively engage in negotiations to restructure the debt. This can involve changing the terms of repayment or converting debt into equity. Board involvement. Take a seat on the company's board to influence key decisions and help steer the company back to stability. Asset sales. Push for selling non-core assets to raise funds for debt repayment and streamline operations. Active management can be time-consuming but offers greater control over the investment. By being closely involved, investors can directly impact the company's recovery process. Passive management. Unlike active management, passive management involves a more hands-off approach. Here, investors rely on the market and external factors to drive returns. Benefits of passive management. Diversification. Spread investments across various distressed assets to reduce risk. A broad portfolio can cushion against the failure of any single investment. Lower costs. Minimal involvement means fewer expenses related to legal fees, advisory costs, or travel. Market trends. Benefit from market recovery trends. If the broader market improves, the value of distressed debt could rise without active intervention. Professional managers. Some investors use funds managed by professionals specializing in distressed debt. These funds pool resources and expertise to manage investments effectively. Passive management suits those who prefer a less intensive approach while still gaining exposure to the high potential returns of distressed debt. Turnaround strategies. Turnaround strategies focus on reviving distressed companies and restoring them to profitability. These strategies often require a combination of financial, operational, and strategic changes. Common turnaround strategies. Restructuring debt. Renegotiate terms with creditors to extend payment timelines or reduce the debt burden. Operational efficiency. Cut costs by streamlining operations, reducing workforce, or optimizing supply chains. New leadership. Bring in experienced managers or board members who have a track record of turning around troubled companies. Asset liquidation. Sell off non-essential or underperforming assets to raise funds and focus on core business areas. Mergers and acquisitions. Merge with a stronger company or acquire smaller, complementary businesses to boost market position and financial health. Turnaround strategies are about making smart changes to restore value. They require a clear plan, strong leadership, and an understanding of the company's core strengths and weaknesses. By using a combination of these strategies, investors can navigate the turbulent waters of distressed debt investing more effectively. Each approach has its own risks and rewards, but together they offer a path to potentially high returns. Legal and regulatory considerations. Investing in distressed debt can be rewarding, but you'll need to navigate a tricky legal and regulatory landscape. These laws and rules can greatly affect your investment strategy and outcomes. Bankruptcy laws. Bankruptcy laws play a crucial role in distressed debt investing. When a company goes bankrupt, it's a big deal, and the rules here can make or break your investment. Impact on investments. Hierarchy of claims. Bankruptcy laws determine the order in which creditors are paid. Senior debt holders get paid first, followed by junior creditors. This hierarchy is important to know because it affects the risk and potential return. Automatic stay. Once a company files for bankruptcy, an automatic stay halts all collection activities. This means you can't sue the company or seize assets until the court says so. Reorganization and liquidation. Companies can either restructure Chapter 11 or liquidate Chapter 7. In reorganization, you might get new securities or cash as part of a repayment plan. In liquidation, the company's assets are sold off to pay creditors. How do these laws impact you? Imagine you hold bonds in a bankrupt company. If the company opts for Chapter 11, you might end up with shares in a restructured firm, potentially valuable if the company recovers. If it goes Chapter 7, you'll get a portion of the asset sale proceeds, which might be less. Regulatory environment. The regulatory environment adds another layer of complexity. Understanding these rules is critical for compliance and avoiding legal pitfalls. Key elements: regulatory bodies. Different agencies oversee distressed debt, including the SEC in the US. They ensure that investments adhere to laws and protect investors from fraud. Compliance requirements. You'll need to follow strict rules for reporting and transparency. This means regularly updating financials and disclosures to keep investors informed. Insider trading. Regulations against insider trading are stringent. As an investor, you must avoid trading on non-public information to avoid hefty fines and legal issues. Cross-border regulations. If the distressed debt involves foreign companies, additional complications may arise. Different countries have their own bankruptcy and financial reporting standards, creating a more challenging landscape. Ignoring these regulations isn't an option. Doing so can result in penalties and lawsuits, severely impacting your investment returns. Always stay updated and consult legal experts to navigate these waters smoothly. Understanding these legal and regulatory considerations is essential for successful distressed debt investing. Both bankruptcy laws and the broader regulatory environment can heavily influence your investment outcomes. Stay informed and compliant to manage risks effectively. How to get started with distressed debt investing. Jumping into distressed debt investing can seem daunting at first, but with the right steps, you can navigate this complex world with confidence. Let's look at the essential steps to get you started. Education and research. When starting out, the first step is to arm yourself with knowledge. Distressed debt investing isn't just about buying cheap debt. It's about understanding the market, the companies, and the risks involved. Read books and articles. Start with well-regarded books on the subject. Websites and financial blogs also offer valuable insights. Take courses. Online courses can provide a structured learning path. Look for courses that cover the basics of distressed debt, financial analysis, and market trends. Follow experts. Keep up with industry experts and analysts who specialize in distressed debt. Their insights can help you stay updated on market movements and opportunities. Education is your foundation. The more you know, the better you'll understand the intricacies of distressed debt investing. Finding opportunities. Identifying and evaluating distressed debt opportunities is crucial. Spotting the right deals can make all the difference in your investment success. Monitor financial reports. Keep an eye on companies' financial statements. Look for signs of distress such as missed payments, declining revenues, or high debt levels. Use screening tools. Financial websites often have screening tools that help you filter companies based on specific financial criteria. Use these tools to streamline your search. Network. Connect with financial advisors, investment clubs, and forums focused on distressed debt. Networking can expose you to new opportunities and valuable advice. Stay updated with news. Regularly read financial news. Many distressed debt opportunities arise from sudden events like lawsuits, management changes, or market downturns. Finding opportunities requires vigilance and a keen eye for detail. Always be on the lookout for signs that a company might be struggling but has potential for recovery. Building a diversified portfolio. Diversification is key to managing risks in distressed debt investing. By spreading your investments across different assets, you can mitigate potential losses. Mix debt types. Don't focus on just one type of distressed debt. Include corporate, sovereign, and real estate debt in your portfolio to balance risks and rewards. Vary industries. Invest in distressed debt across various sectors like tech, retail, and manufacturing. Different industries have different risk profiles, which helps in reducing overall risk. Include different regions. Look beyond your local market. Investing in distressed debt from different countries can offer new opportunities and spread risk. Allocate wisely. Decide how much of your portfolio you want to allocate to distressed debt. Generally, it's wise not to put all your money into high-risk investments. A diversified portfolio acts like a safety net. If one investment fails, others can keep your portfolio balanced and profitable. By educating yourself, finding the right opportunities, and building a diversified portfolio, you can get started on the right foot in distressed debt investing. Take these steps seriously and you'll be well equipped to navigate this challenging but rewarding field. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.